Let's talk about what really happened today, because if you chased silver after seeing the headlines, this probably didn't feel like a normal trading day. It felt like a betrayal. One minute the market was screaming opportunity, the next minute it was quietly reaching into your pocket. And no, this wasn't random. This was textbook market behavior, the kind that repeats over and over for anyone willing to look past the hype. Yesterday, the financial media went into full echo mode. Bank of America, one of the largest and most influential institutions in global finance, dropped a research note projecting silver prices significantly higher over the coming years. That single report spread everywhere within hours. Social media lit up. Newsletters blasted it out. Commentators rushed to frame it as confirmation that silver's big moment had arrived. Retail investors didn't hear nuance or timelines. They heard urgency. They heard, "This is it." By Wednesday morning, buyers rushed in. Silver surged hard and fast, pushing up toward the low 80s. On the surface, it looked like a clean breakout. Momentum traders piled on. Chart watchers convinced themselves resistance was gone. The mood flipped from cautious optimism to outright euphoria. And right at that emotional peak, the market did what it almost always does in those moments. It turned. Selling didn't trickle in. It slammed the tape. The price didn't stall politely or drift sideways. It dropped. Hard. Within hours, silver was trading several dollars lower, wiping out gains and leaving late buyers staring at losses they weren't emotionally prepared for. Anyone who bought near the highs learned an expensive lesson in real time. Headlines don't move markets by themselves. Liquidity does. This wasn't an accident. It was a classic sell the news event. Big players don't exit positions quietly. If you're sitting on millions of ounces bought far lower, you can't just dump them without collapsing the price against yourself. You need buyers. Lots of them. And the easiest way to summon eager buyers is with a compelling story. Ideally, one delivered by a trusted name. Think about it from the perspective of a large fund. You've been long silver since it was in the 60s. The trade has worked. You're deep in profit. Now price is pushing into the 80s, an area where supply has historically shown up. You want out, or at least lighter, but you need volume to absorb your selling. Enter a bullish bank report that lights a fire under retail demand. Perfect timing. Coincidence? Maybe. Useful? Absolutely. As retail buy orders flooded in, they created a wall of liquidity. That wall didn't protect price. It allowed larger players to sell into strength without immediately collapsing the market. Once distribution was done, the support vanished and price fell under its own weight. This is not manipulation in the cartoon villain sense. It's how markets function when different participants operate on different time horizons and capital scales. Technically, the damage matters. This wasn't just a bad afternoon. Silver has now tested the same upper zone twice and failed both times. Late December saw a spike toward the mid-80s that was aggressively rejected. Today's rally stopped just short of that previous high and rolled over again. That's a double top, and traders pay attention to it because it signals something very specific. Sellers are active, organized in defending that level. Charts have memory. Every trader who bought near those highs and got burned remembers it. When price approaches that zone again, those traders are quicker to sell, and aggressive sellers are already waiting. Until silver can break decisively above that ceiling, the market is telling you it's range-bound, not trending. Breakouts don't happen because people want them to. They happen when supply is exhausted. It's also important to zoom out and look at the broader complex. Silver didn't fall in isolation. Gold was down on the day as well. Not dramatically, but enough to confirm this wasn't a silver-only story. When gold softens, silver almost always overreacts. That's the trade-off for its upside torque. On the way up, silver moves like it's late for a flight. On the way down, it trips over its own shoelaces. The driver behind gold's pullback was likely the bond market. Yields ticked higher, and when yields rise, paper gold tends to see pressure. Silver, being the high beta sibling, amplifies that move. But here's the key detail most people miss. Gold didn't break down. It held a major support level and looked more like it was consolidating than collapsing. That tells you something important. Silver's move was exaggerated. Emotional, not structural. This brings us to the psychology of big price targets. When a major bank publishes a number, especially one that sounds dramatic, retail investors often compress the timeline in their minds. A multi-year projection becomes a next week expectation. A structural thesis becomes a day trade. That mismatch is where damage happens. Bank analysts are not talking to day traders. They're modeling supply deficits, industrial demand, and capital flows over years. When that long-term view collides with short-term leveraged positioning, volatility does the rest. If your thesis spans several years, a $2 drop is irrelevant. If you're trading with leverage and tight stops, it's catastrophic. Same market, completely different outcomes. None of this means the report itself should be dismissed. In fact, the most important signal today wasn't the price action. It was the messenger. Bank of America has not historically been friendly to precious metals. For years, they were associated with some of the largest short exposures in the space. They downplayed silver, framed it as a secondary industrial metal, and consistently dampened enthusiasm. Now they're publishing bullish scenarios and openly discussing supply constraints. That's not noise. That's a narrative shift. Institutions don't pivot publicly unless something has changed behind the scenes. Analysts don't risk credibility by flipping a long-held stance without conviction or permission from above. The report, authored by Michael Widmer, isn't fringe commentary. It's institutional-grade research meant for pension funds, asset managers, and sovereign capital. And within it were admissions that would have been unthinkable a decade ago. The first is that silver supply is inelastic. Mining production cannot respond quickly to higher prices. Even sustained rallies won't immediately bring new supply online. Projects take years, not quarters. That single point matters more than any short-term price move. If demand continues to rise, particularly from solar and electrification, and supply remains flat or declines, price has only one long-term direction. But markets don't move in straight lines. They move in waves, shaking out weak hands along the way. So, yes, today hurt for anyone who chased the headline, but it also revealed something deeper. The pump may have been overstated. The flush may have been painful. But the institutional pivot is real. Smart money isn't emotional. It's patient. And it doesn't care if retail gets shaken out along the path. The destination might be much higher. The road there, however, is going to be rough, uneven, and occasionally designed to make you question your sanity. Welcome to the silver market. At some point, the story stopped being about whether higher prices could solve the silver shortage, and today was that moment. One of the most important takeaways from the Bank of America report wasn't the headline number people got distracted by. It was what they quietly admitted underneath it. Higher prices will not magically fix this market. The shortage isn't cyclical, it's structural. That single admission dismantles the old bear case that silver supply will rush in once prices rise. It won't. It can't. And the bank finally said it out loud. The second admission might be even more uncomfortable for skeptics. Solar demand isn't slowing down, and it isn't getting thrifted away. For years, analysts repeated the same comforting story. Engineers will use less silver, copper will replace it, efficiency gains will save the day. Bank of America just waved a white flag on that narrative. The research now assumes the green energy transition consumes silver faster than miners can pull it out of the ground. That's not hype, that's arithmetic. It also validates what industrial players like Samsung have been signaling for months. Silver isn't optional in advanced electronics and solar, it's essential. Then came the third admission, the one that quietly rewrites silver's entire identity. The report linked silver's price not just to industrial demand, but directly to gold. They acknowledged that as gold pushes into higher price regimes, silver has to follow to maintain the ratio. That's another way of saying silver isn't just a metal, it's money. Coming from this institution, that's not a small shift, it's a full capitulation. The bank that spent years fighting silver demand just admitted the math no longer works against it. When your loudest opponent stops arguing, it's usually because the evidence has become inconvenient. So why does any of this matter if the price got smacked today? Because serious capital doesn't trade off viral clips or emotional candles. Pension funds don't make allocation decisions because a chart looks exciting on social media. They move when research from major banks gives them cover. Picture a conservative fund manager overseeing retirement money for teachers or firefighters. They might like silver, but liking it isn't enough. They need institutional permission. They need a document they can slide across the table and say, this isn't reckless, this is researched. Bank of America just gave them that document. That piece of paper removes reputational risk. It tells committees and boards that owning commodities, and silver specifically, is defensible. So while day traders were hitting sell buttons during the flush, allocators were doing something far less dramatic. They were reading, forwarding the report, scheduling discussions, preparing allocation changes that don't happen overnight but do happen inevitably. Capital at that scale moves slowly, but when it moves, it doesn't day trade. Of course, it would be naive not to ask the uncomfortable question, why now? Why would a bank that historically leaned against silver suddenly publish such a bullish framework? If they were still heavily short, talking the price down would make more sense. The simplest explanation is usually the right one. They're likely not short anymore. Over the last month, during the low liquidity volatility and violent shakeouts, it's reasonable to believe they reduced or exited those positions. Once you're out, your incentives flip. You stop suppressing and start promoting. That would also explain the aggressive rally at the start of January. Retail alone didn't do that. Banks front-run their own research all the time. First they accumulate, then they publish, then they let the narrative do the work. It's not personal, it's business. Wall Street has always followed the same script. Break it so you can buy it, then talk it up so you can sell it later. Right now, we're in the talking it up phase. Cynical? Sure. Bullish? Absolutely. There's another effect of a big bank publishing a bold number that most people underestimate. It shifts the psychological range of what feels possible. Before this report, talking about triple-digit silver got you laughed out of serious conversations. Now the response is different. Well, Bank of America thinks it could go much higher. That alone changes behavior. $80 stops looking expensive. It starts looking like a stepping stone. That shift in perception is how bubbles are born, and bubbles don't start without institutional blessing. Targets don't just reflect expectations, they shape them. Traders buy because they believe others will buy. Refiners hoard because they expect higher replacement costs. Producers slow sales because they think tomorrow's price will be better than today's. The narrative feeds the behavior, and the behavior feeds the price. That's how markets overshoot. The sell-off today was mechanical. The narrative, however, just gained 10 times more power. And narratives, once planted, are very hard to kill. Still, none of that erases the chart. Price action doesn't care about research notes, and technicians are right to be uneasy. The daily candle was ugly. We lost $80 and didn't get it back. And yes, what's forming on the chart looks like a classic double top. Anyone who trades patterns is staring at it and feeling their stomach tighten. The facts are straightforward. Late December saw silver spike above $83 and reverse sharply. Today's rally failed just below that level and reversed again. Two peaks, similar height, both rejected. Textbook. According to the manuals, this suggests buyer exhaustion and warns of a deeper pullback toward the neckline. That neckline sits far lower, around $70. No wonder social media is panicking. If you only trade patterns, the signal says danger. But markets don't exist in textbooks, especially during inflationary supercycles. Patterns that work beautifully in quiet conditions often fail when supply constraints and monetary stress dominate. Double tops in these environments frequently morph into handles instead of reversals. Price doesn't collapse, it goes sideways. It absorbs selling, then it breaks higher when the sellers finally run out of inventory. That's where context matters. Look closely at today's volume. It was elevated, but it wasn't blind panic. It mirrored the volume on the way up. That's not fear, that's profit taking. Now look at how price behaved afterward. Each dip into the high 78s was bought, repeatedly. Price didn't waterfall, it stuck. When you see heavy volume paired with price refusing to fall further, it usually means accumulation is happening under the surface. Those buyers aren't day traders. They didn't chase the breakout. They waited for exactly this kind of flush. Institutions prefer discounts, not excitement. They let emotional traders fight it out, then step in quietly when price stabilizes. Weak hands sell in frustration. Strong hands absorb and don't let go easily. So where does the line get drawn? The immediate battlefield sits between $78 and $75. The current level around 78 matters because it was a prior breakout zone. Holding it tells us the market doesn't need a deeper reset. Below that, $75 becomes the fortress. It capped price for most of December and should act as serious support if tested. As long as that zone holds, the larger trend remains intact. If $75 breaks decisively, the conversation changes and risk increases. But until then, this looks less like a trend failure and more like a deliberate shakeout. The short-term structure is bruised, no question. Before emotions run away with the narrative, there's a basic market rule that needs to be brought back into focus. Old resistance becomes new support. That's not a slogan, it's market physics. If silver drifts down toward the $75 area, that level isn't random. It's the line every serious participant already has marked. Banks see it, algorithms see it, physical buyers see it, stackers see it. There are buy orders stacked there like sandbags. If price tags $75, it shouldn't melt through like butter. It should bounce, and bounce aggressively. Now, let's be clear. If silver were to decisively break below $75 and stay there, that would be a problem. That would turn this move into a failed breakout, and failed breakouts tend to invite deeper corrections. But that's not where we are. We're still several dollars above that danger zone. That matters. A 3% pullback feels dramatic when you're watching it tick by tick, but it S-noise when you zoom out and realize you were still sitting on a 20% cushion from the breakout. Perspective is everything in markets, and perspective is usually the first thing panic takes away. Look at the momentum indicators, specifically the RSI. Yesterday, the daily RSI was pushing into the high 70s, flirting with 80. That's overheated territory. That's an engine redlining. Markets can't sustain that pace without consequences. Today's drop didn't break the trend, it fixed the problem. The RSI cooled off into the low 60s, which is exactly where you want it in a healthy bull market. Think of it like a long road trip. You don't floor the accelerator the entire way unless you enjoy blowing engines. Sometimes you slow down, grab some water, and then keep going. That's what the market did today. It caught its breath. Ironically, this pullback may have saved the rally. If silver had kept ripping straight through the 80s without pausing, the eventual correction would have been far uglier. Blow-off tops feel amazing right up until they don't. What we're seeing instead is consolidation, and consolidation is boring, frustrating, and absolutely necessary. Sustainable trends are built on sideways digestion, not vertical lines. Now check in with gold because silver doesn't exist in a vacuum. Gold slipped about $30, roughly a 0.75% move. In gold terms, that's barely a scratch. Gold is still hovering near all-time highs and remains firmly in an uptrend. As long as gold is bullish, silver is not entering a bear market. It simply doesn't happen. Silver is volatile, yes, but it doesn't divorce itself from gold's primary trend. Physics won't allow it. The gold to silver ratio widened slightly, ticking from around 56 back toward 57. That actually makes silver cheaper relative to gold than it was yesterday, and that matters more than most people realize. Ratio traders and arbitrage algorithms don't care about headlines or emotions. When the spread widens, they step in automatically, buying silver and selling gold to rebalance. Gold, in that sense, acts like an anchor. It keeps silver from drifting too far off course, even when silver is having one of its emotional days. Which brings us to the headlines you're almost guaranteed to see next. Silver crashes. Bubble bursts. Investors flee commodities. The media loves a dramatic red candle. It gets clicks. They won't mention that silver is still massively up on the month. They won't explain the mechanics behind the move. They'll just show you the red number and let your emotions do the rest. That's their business model. But you're not flying blind. You understand what happened. This wasn't a collapse of fundamentals. It was a sell the news flush triggered by a high-profile report and amplified by short-term traders. It was tactical, not strategic. The structure is still intact. Support is still holding. Indicators are resetting, not breaking. Ugly does not automatically mean fatal. So what do you actually do now? Do you panic sell? Do you try to trade every wiggle? Do you double down blindly? This is where professionalism matters. Over the next 48 hours, there's really only one thing that counts. The weekly close. Intraday chaos is for amateurs. Professionals care about where the market settles when the dust clears. The bull's job is simple. Hold above $75 into Friday's close. If that happens, the weekly candle will show a long wick and a green body. That tells every system watching that the breakout is still valid, just volatile. Volatility in an uptrend is normal. If, however, price is pushed below $75 by Friday afternoon and closes there, that would signal a failed breakout and open the door to a deeper pullback. That $75 line is the battlefield. Everything else is noise. Given the physical shortages, the strength in gold, and the institutional backdrop we've discussed, the odds favor that level holding. Not guaranteed, but favored. Markets aren't about certainty, they're about probabilities. Now let's address the elephant in the room, the big target. After a day like today, hearing numbers like $300 sounds almost absurd. It feels disconnected from reality when you're staring at $78 on the screen. But this is where separating timing from destination becomes critical. No one said silver was going to $300 this week. The thesis is about this cycle, not this Wednesday. Ask yourself what actually changed today. Did solar panels suddenly stop using silver? No. Did global debt reverse course? No. Did miners discover massive new deposits overnight? No. The math that supports much higher prices didn't move an inch. Inflation, scarcity, and monetary stress didn't vanish because of one red candle. Today was about sentiment, positioning, and liquidity. It wasn't about fundamentals. If you bought silver because you believe in the long-term thesis, a couple of dollars of downside shouldn't shake you. That's a rounding error on the path to multiples higher. Obsessing over every dip is like staring at potholes while ignoring the destination. The road is bumpy, it always is. Here's the hardest advice in finance, and the one most people ignore. Sometimes the best trade is no trade. When markets are whipping back and forth, trapping longs 1 hour and squeezing shorts the next, trying to be clever usually ends in regret. Sell at 78 hoping to buy at 76, and the market will often rip higher the moment you do. It's not personal, it's just how crowded trades unwind. If you already hold physical metal, you're not obligated to react to every tick. You're not inside the casino playing every hand, you own the chips. Let the traders and algorithms fight it out. Step back. Watch the levels. Let time do the heavy lifting. On the other hand, if you're sitting on cash and missed the move at $70, this pullback is a gift. Markets rarely give second chances at clean retests of support after a breakout. Prices between $75 and $78 are not something to fear. They're something to respect. This is where risk is lowest and reward is asymmetrical. Waiting for $60 at this point is like waiting for last year's weather. The floor has moved higher. So here's the final verdict. The Bank of America report likely created liquidity. Institutions used the excitement to adjust positions and reset exposure. It was ruthless, calculated, and entirely on brand for Wall Street. But it doesn't invalidate the bigger picture. Silver remains historically undervalued. Physical supply is tight. Demand is accelerating. Capital is waking up. You lived through the shakeout. You didn't get forced out at the top. That matters more than you think. The path higher is not a straight line. It never is. It's a series of advances, pullbacks, tests, and battles. Today wasn't the end. It was one of those battles. Hold your perspective. Watch the $75 level. Ignore the noise. And remember why you got involved in the first place. Conviction is always tested right before it's rewarded.